The Federal Reserve went ahead with a 25 basis point rate hike, even as banks tighten credit. Will these forces push us into recession? Joining me now is Bank of America head of U.S. economics, Michael Gapen. Michael, thanks a lot for coming on the show. Appreciate it.
Thanks for having me on.
So obviously all the eyes have been on Jay Powell for years now, but with this banking crisis or mini banking crisis, lending standards have been getting very tight, and I've heard anecdotally that some of the smaller community banks have almost shut the door. With those two things combined, how much will that slow the economy?
Right. Well, that's the big open question, and I think, to some degree, this should be expected. This is one of the main channels through which the Federal Reserve can slow the economy. So we should expect lending standards to tighten. We should expect loan growth to slow. The question is essentially, have recent events meant that we're going to get a lot more tightening than we thought? So excess tightening or unanticipated tightening. So is there a credit shock, a credit crunch around the corner? So it's true that loan growth was slowing coming into this event. It'll probably slow further. And so if we get a lot of excess tightening, yes, it's going to do some of the Fed's job for them, and I think the Fed said that this week.
Yeah, Jay Powell did, yeah.
Fed, he essentially mentioned that, and yeah, so it's probably a disinflationary shock in that world, so the Fed may have to tighten less. Slower loan growth or even declines in loan growth would help the economy slow down and bring inflation down.
So when you combine those with the 25 basis point hike and all the other hikes we saw before that, has the Fed essentially been too aggressive? If you look at year over year, inflation's pretty high. But if you look at more recent indicators, Case-Shiller housing index has been down 6 straight months, and I think everyone expects next week we'll see a 7th straight month. That's worrisome.
It is. I would say it's too early to know. I don't think the Fed's done too much. Certainly housing has slowed. Business spending on structures and equipment, that slowed. Manufacturing production has started to come off. So this is kind of the next step. Bank loans and standards are tightening. Credit growth should slow. It's hard to argue we've over-tightened if we just added 311,000 jobs. So essentially, it's an investment-led slowdown right now. We suspect it'll transition to a consumer slowdown later this year. I don't think the Fed's overdone it, but we'll see. We could get a very large negative shock to credit growth out of this, and the Fed could have to backpedal. But right now, the data doesn't suggest that's the case.
Well, certainly the jobs is that one thing that has really held up to some people's surprise. You, however, have been predicting a mild recession. At least you said the odds are pretty high of a mild recession. Anything in this past week change your mind, make it more likely?
I would say the events of this past week have opened up downside risks to our outlook for the first time in what I'll call the reopening phase of the pandemic, when the economy has just shown a lot of strength and wanted to keep going. So I would say kind of it's twofold. One, the path from housing to business spending to manufacturing to bank lending, that's very consistent with the slowdown, so it makes me comfortable with our outlook overall. But I do think these events represent downside risk to the economy, which could mean the Fed, there are worlds in which the Fed's going to have to shift to precautionary rate cuts, as it's done in the past, or maybe even move to outright rate cuts quicker. We'll see. But yes, it makes me kind of feel comfortable with where we are.
Okay, so in addition to fighting inflation, I think the Fed's original mandate back in the early part of last century was actually stability in the financial sector, and now suddenly that's a real issue. How do they find a balance between not wanting a run on the banks, but also not giving bankers an open door to take lots of risks because, hey, the federal government will backstop it, the so-called moral hazard? The
moral hazard argument, right. So certainly, first and foremost, you do have to respond to events if you think that there's a systemic risk event there. That's essentially what they've done. And you're right, that was the Fed's original mandate. In some ways, and I don't want to make this overly literal, in some ways it's good that the shock happened in the banking sector. The Fed's good at understanding these issues. It has the tools to go fight them directly and the experience. So I think there's experience there that should help us out. But you're right, every time we do that, it raises the risk of moral hazard. What will likely be coming down the road then is additional regulation, maybe to some degree the reversal of the rules in 2018 that reduced regulatory burden on banks with 50 billion to 250 billion in assets. So in general, you come back with typically more regulation, and to hopefully that you ensure the incentives between bank owners and their shareholders.
As long as it's smart regulation. I
That's
mean,
right.
they missed
Right.
it this time around. One more question for you, a few seconds left. It seems that there isn't much reason, if I'm being mercenary about it, to go with a small bank right now. If I had a big payroll to meet, I might think, gee, I'd like to put that with one of the too big to fail banks. Is there a danger that money will continue to flow out of the smaller institutions?
Yes, I think you could argue high yields on money market mutual funds are causing deposit outflows, and recent stress events could lead some deposits to flow into bigger banks. I do think that will be an ongoing challenge over time.
Michael, thanks so much for coming on the show.
Thank you.